Steve Liesman is here, and you have been
commenting while I was talking. I was doing the play-by-play
as we're going. So give it to the audience.
This is a potentially game-changing employment report, and I'll tell you what is changed here. We had pretty good data that the jobs market was slowing, and we're pretty darn sure it was slowing. The Labor Department comes forward and says, no, you had that nearly completely wrong. Well, not nearly. We were thinking about low hundreds, below 100. Let's take today's number, 131, but you had the census workers come off, which was the opposite of what was expected, and you had the strike. So let's add back. Let's go 131. Let's put back 15 for census. Let's put back 40. We might be upper near 2, okay? Stop there. September was 114,000. It's a lot weaker than we thought. Now it's 167. August, 122. Now it's 163. I'm just talking about the private sector here, not to mention the overall. I think one of them was up. The headline was up above 200,000, if I'm correct about that, with the revision. Anyway, we have to think that the jobs market is potentially slowing less than we thought to a much higher sustainable rate. And Powell had this pretty well right when he called a hold here. And I don't know what he knew. We always have that discussion. It's not worth having. In any event, the idea that the job market has not slowed as much and that there's more than that, I think, who was it? Was it Joe said the 10-year was higher? That makes sense. You should some sort of lift it all to the term structure here, because that's going to back off the idea that we have this gathering weakness. Whatever's happening in the economy, it hasn't shown up in claims, and it's really not in a big way showing up in the jobs report.
Except everyone's worried about CapEx, which is a separate issue, not represented here.
That's the interesting part, though, is that we really worry about corporate confidence deteriorating because of trade, and was it going to stop spending as well as hiring? That doesn't turn out to be the case. I mean, I think this is an unequivocally strong report. And to echo this point, the Fed is telling us that they were doing a mid-cycle adjustment. That is, in fact, what that was. And the economy is in fine shape.
We haven't given a shout out to Jason yet.
The winner.
The winner.
Winner. Chicken dinner. Why did you see a stronger number? Was it?
This is stronger than I would have expected because you had those revisions to the previous 2 months. I think Steve has it right here. I don't think any one number on jobs should change our view of the economy. This one changes mine a bit more than your average month does. You have the pace of job growth in the last 3 months exceeding the pace of job growth we had in the first 7 months of this year. That's something that's surprising, given all the increase in uncertainty we've seen, given that should be trending down. You had wage growth okay this month. You had the participation rate rising this past month. So this, to me, looks like a very surprisingly healthy labor market.
Can I put a quick number on that, Jason? I want to put a quick number on that real quick, which is, if you remember at 7:30, I did a quick hit that showed the 3-month average was 157,000. That's wrong. The 3-month average now that I would have reported back then, had I known what we know now, was 188,000, and the new 3-month average is 176,000. So sorry, Jason, I just want to put some numbers on that change that you were talking about.
Do we have to now wait?
And I wouldn't expect we can keep up with 176,000. I mean, that to have that for the next year.
Still come down.
I think it's going to still come down, but it's coming down. Seems to be coming down more slowly than I thought.
Do we wait now till 10 o'clock to make sure ISM manufacturing doesn't curb the enthusiasm from this report?
We have to really think hard about how this economy operates. And I think we all grow up with a certain understanding of the economy. And I remember my dad coming to me and saying, how are we going to survive without manufacturing? Are we all going to sell each other insurance policies? That's a direct quote from Marvin Liesman, in case anybody's interested. And I didn't really have a good answer, and I still don't have a good answer. What I know is that we seem to be able to survive selling each other insurance policies with manufacturing going down as a percentage of employment and remaining stagnant or pretty much the same or stable as a percentage of total overall output.
Yeah, I would echo that. I think the service side is going to be much more important. And given how strong and how broad that strength was in this labor market report, I would be surprised if the market reacted negatively to a weaker than expected ISM.
In terms of stocks that you would look at, sectors, names, as a result of this, is there anything that you'd actually focus on?
Well, the last couple of days, there's been a little bit of a favorability back towards the technology growth-oriented names. Now, we had seen a move towards value. We had seen that there were European opportunities, emerging market opportunities, opportunities in financials. There was the expectation that there was going to be a cyclical recovery. So does this revert back to that thinking that there is a little bit of a cyclical recovery going on domestically and globally, in which that makes value come back once again? I need further evidence for that. I still suspect that for the investment community, the right way is to look for companies that are cash rich, low in debt, strong margins, and that takes you to technology and to growth-oriented type of equity names.
Okay. We have not.
Michael, is Michael there?
Yeah, Michael.
Michael's there. We got to get to Rick. We got a lot of folks who've been waiting patiently. But Michael, go ahead.
Well, I've been trying to keep quiet because I don't want to be the guy that pours cold water all over the celebration.
It sounds like that's about to happen. That's like a comma, but here we go.
That's precisely what's about to happen. I think there's no question it was a strong report, and certainly it kind of nudges up my view of the underlying strength of the labor market. I think it's important to kind of step back and look at where we are at the 30,000 foot. Yes, we're stronger than we thought we were yesterday. But we are still seeing a deceleration relative to a year ago. We're seeing that in the labor market. We're seeing that also in the GDP numbers. So we're seeing a weakening. The slope is negative over a year, but we're still in a good place, and that is surprising. Given all the headwinds that the economy is facing from the reduction of fiscal stimulus, from the trade war. The question, I think, is how long does that last?
Right.
How long can we continue to have CapEx not grow without that affecting hiring? How long will it take for that not to affect consumers who are really holding up the economy?